What is the Blackstone view, the operating thesis right now about where we are in the economy and where it's headed, on inflation, on whether we're going to have a big downturn or not?
Sure. Well, on the macro, which obviously affects everything, we do benefit from having the lens of a really big portfolio of investments. So we have stakes in over 200 companies that together have over 200 billion of revenues in aggregate. We have a real estate portfolio with over 12,000 individual assets. We have a very big private credit portfolio. So that's a very sort of rich sample. And I'd start with the good news. So the good news first, I think, is we pretty definitively see inflation trending down. You know, if you look at the inflation prints, the standard metrics, and you adjust for shelter, which sort of lagged on the way up and is now lagging on the way down. If you look, for example, at core CPI, a very important metric, ex shelter, that's running in the mid threes. And if you look at CPI by itself, ex shelter, it actually hit about 2% last month. So we definitely see the direction of travel being down. Other good news is the performance of and resilience of the economy and of many companies to date. So in our own portfolio, we talked about this publicly in the first quarter, our private equity portfolio companies grew at double-digit revenues in the first quarter with stable, resilient margins. We see in our portfolio, clear signs that costs have peaked in the last few quarters, including with respect to wages, very importantly. So there's some good news on both those fronts. Now, against that, of course, is the challenge of the cost of capital and the availability of capital. And there, I think you see the confluence of three really big things. First, obviously, the escalation in short rates over the last 14 months or so, 500 basis points. I think the Fed has basically achieved its goal of achieving positive real rates for the first time in this country in many years. And we're going to take the Fed at its word and plan for higher for longer short rates. Second, quantitative tightening. You know, as you and I know, I think a few years ago, we sort of couldn't stop talking about QT. And now I think we don't talk about it enough. And so pre-COVID, the Fed balance sheet, as you know, was $4 trillion or so. It more than doubled in the subsequent couple of years. And now they're embarking on a balance sheet reduction program where they're basically, through runoff of assets, shrinking that balance sheet by about $1 trillion, annual run rate a year. So that's going to have significant effects over time, and we already see some of the impact in certain markets and how they're behaving, like agency mortgages. And then third, as a result of the banking challenges, especially the regional banking challenges of earlier in this year, we do think you'll see credit contraction from that over time. So those are three big forces, and I think the result of all that is the Fed is basically going to deliver what it intended, which is a slowdown in the economy. And I think, you should expect to see deceleration in the economy, in the coming months.
So take all that together, a complex and nuanced view, strength in the economy, at the same time, reduction in liquidity, some uncertainty. What does that mean for deal making? Because we saw at the end of last year, going into the beginning of this year, it almost dried up. I mean, M&A really went down a lot. What are you seeing at Blackstone?
I think we're seeing the overall M&A cycle playing out probably as we more or less expected even a year ago, which is you had this really big rate shock, again, the 0 to 500 basically in 14 or 15 months. And during that time period, M&A activity essentially froze. We are now seeing on the ground some thawing of that freeze. And I think the reasons for that, having seen these cycles before, are that seller expectations need to be recalibrated, and that takes time. It generally takes sort of 12 to 24 months after a market shock or after a cycle bottom. And so I think that process is playing out. And then in this particular circumstance, I think market participants are now, seeing that we're nearing the end of this dramatic rate increase cycle, and therefore feeling like there's a little less uncertainty, a little more certainty, and are readier to transact. And so if you look at our own business, just in this month of June, we've been busy people. And so in the last couple of weeks, we announced things like a $2 billion investment in one of the country's fastest growing utilities, an almost $1 billion additional investment in the country's largest private developer of renewables. We're financing, in partnership, a potential vaccine for pneumonia. In the logistics area, real estate, which we're big fans of, we've been selling and buying. We announced the sale of over $3 billion of logistic assets to a public company earlier this week, and we also acquired 3 different portfolios of logistics assets in both the US and Europe. So I think those probably constitute green shoots or potential green shoots. I think you'll be hearing that term will be more in fashion this summer, I think, among Wall Street types. But really for us, in terms of our business model is really made for times like this. At its core, we're all about long-term, locked-up, committed capital through fund structures. And what that allows us to be is patient, and it allows us, obviously, to have capital at a time when capital is short. And indeed, we have nearly $200 billion of dry powder to invest opportunistically in the coming time period. And our history has shown that those couple of years coming out of a cycle are some of the best times to invest. So we're excited about what the future will bring.
As you look at the landscape out there, where are the investment opportunities, and how dependent are they on assumptions that were done or close to done with the hiking of the rates?
Sure. Well, it's a multifaceted answer, and we have a broad business, and so we have sort of a balanced attack and aren't relying on one single strategy. But I think for sure on the credit side, lending money right now in this environment is a very compelling thing to do with very good risk reward. Probably some of the best risk reward we've seen in a long time in the credit area. So in things like direct lending, you can generate double-digit returns given where base rates are and spreads for being in the very senior-most part of the capital structure with a lot of equity beneath you. So that is very attractive. In other forms of private credit, whether it's asset-backed credit or real estate credit, similarly, it's a very good time to invest from a risk-reward standpoint. So that's one big theme. And then on the equity side, a little bit apropos what I talked about when I went through the deals we're doing, I'd say we're still applying some of our same key themes around sort of the sectors and areas we want to invest in. But now we think we'll do it in a more interesting environment, maybe a somewhat more dislocated environment to find value. So that's really how we're approaching it.
You mentioned real estate. Obviously, Blackstone has a very substantial presence in real estate. It's been a lot in the news. There's a lot of report of the challenges for commercial real estate. What is your perspective on that? Are we headed toward a real substantial downturn in real estate?
Well, it's interesting. I think, when you see the acronym CRE in a newspaper article, you can be sure it's probably going to portray the sector and paint it with a broad brush. And the reality is, there's real bifurcation in terms of the dynamics in real estate as an industry. It's a big industry. You have one sector, traditional office, especially in the U.S., that really does have fundamental challenges and vacancy levels of 20% plus and so forth. That happens to be a very small portion of our portfolio, less than 2% of our global real estate equity portfolio. And then you have a number of sectors where, fortunately, we're concentrated through, I think, some good sector selection decisions, like logistics, data centers, a number of areas in rental housing, life sciences office, where the fundamentals are really quite good. Vacancies in many of those sectors are at 2 to 5%, which is almost at or just above the frictional level of vacancy. Market rents growing at double digits in a number of those sectors. So it really matters where you invest. And the portfolio construction I think our firm has created in real estate over the last decade are really, some of our finest work as a firm. Artificial
intelligence, particularly generative or large language model artificial intelligence, very much in the news these days. Start with Blackstone. What difference might it mean for Blackstone's operations before we get to the investment in AI?
Well, it's a really good question. Obviously, a lot of focus, and we've been focusing on the potential in this area for a while. I'd first, just big picture, say that I believe AI will reinforce and further the advantages of private market investing relative to public market investing.
Why is that?
Well, I think the reason for that is it's actually pretty simple. Public market investing, which relies obviously on publicly available data, that sort of data will be increasingly and further commoditized in an AI world. And in contrast, the value of proprietary data and insights that you can glean from a really large private market portfolio accumulated over many years across many businesses, the value of that sort of information and data and ability to mine insights from that and have pattern recognition coming out of that, both longitudinally and across your business, that will only be further enhanced, again, relative to public market investing. So I think that is a big picture perspective. For us on our business, you mentioned this, first operationally, I think for sure over time, there'll be efficiency gains in our business processes and our operating processes from leveraging these tools. And then on the investing side, which you were getting at, obviously lots of focus. You could say there's a bit of a gold rush mentality right now. We're going to be very careful and thoughtful about how we go about it. But what I'd say is we've already been able to action what I would call some derivative plays relative to the space that we already know are going to be big winners in the ecosystem.